Welcome to our Foundation for the Study of Cycles Market Forecast 2024, Session 3, the grand finale. Welcome to our Foundation for the Study of Cycles Market Forecast 2024, Session 3, the grand. Welcome there. Apologies for the echo. Welcome to our session. This is Ron William. Honored to be here with you as FSC Development Director and Cycle Practitioner. We will be continuing to celebrate the highest record signups. Thank you for signing up and attending across all three sessions. I know some of you may be choosing one or the other, and others all three. So it'd be great to know which of you have chosen what. It continues to be the live 2-hour immersion of a net mix of superb speakers, 6 speakers in total. Each one, as always, has 45 minutes to present key insights with a 15-minute Q&A. I encourage you all to warm up those Q&A talking points throughout the session so that we can capture them and engage post-session. And as my way of encouraging that warm-up, I was just chatting with some of you now on YouTube live stream. Share your response on the YouTube chat in terms of our FSC Social Connect call out. Which country are you based in? What market or cycle views do you have, which might be thematic or timely? And then what I think would be most useful, given that we're at the top of the third session, the grand finale for our event, is to share key insights from our FSC Market Forecast 2024. What was most impactful or top of mind across all the past 2 sessions? And just to build on that intention of learning and having actionable trade ideas along with impactful insights, these are some of the summary points I picked up from our guest speakers previous yesterday: Jake Bernstein, FSC board member, but also Robert Prechter, president and founder of Elliott Wave International. Just a brief review. Jake shared a broad cross-asset outlook of 2024, but first explained, most importantly, the key factors behind his previous non-consensus bull market prediction for equity markets in 2023, which he still expects to rise higher. A deep dive of his signature rules-based process followed while reviewing top cycles on his radar, supported by major sentiment and timing triggers. Additional market calls were reviewed across rates being lower, higher for precious metals, with silver to outperform, palladium likely to post a cyclical low this year with an explosive upside to follow, and a major bottom on the pound in the mix with a long-term top in real estate going into 2028, 2030. Just on that point, I'll pause there. Jake, you had a few words to share about resources for our FSC members.
Yes. I'm going to provide the foundation with a video entitled My 6 Best Timing Triggers, which you're free to share with everyone. It explains my specific methodologies, setup, trigger, follow through, which will serve as an adjunct to what I did yesterday. And by the way, yesterday, I am sorry, I did not do my best work yesterday. I was having some very serious trouble with Zoom and with my PowerPoint. So I'm going to re-record the session I did yesterday in its entirety, including some new forecasts, which I'll make available also to the foundation to share with anyone who wants it. One more thing, if I may, Ron. I will also be speaking at several sessions next week at the Wealth Conference, and people were asking about my presentations. On Tuesday, I will present a presentation entitled Which Timing Triggers Did Best in 2023 and Which Ones Are Scheduled to Do Best in 2024. That'll be on Tuesday. And on Saturday, not this Saturday, but the Saturday after, I'll be presenting Artificial Intelligence, Actual Intelligence, Absolute Idiocy, How to Make AI Work for You in terms of timing. This will all be very specific and clear, and the attendance is free. Here is the login, the sign up if you're interested in attending. I'm sure you will enjoy it. I'm not the only speaker. That's really all I have to say. I don't want to hog anyone else's time today, but I will be doing that presentation yesterday. I'll be doing it over and I'll be doing it the right way so as not to disappoint. I want to be perfectly clear. Thank you.
Thank you very much, Sheikh, and we really appreciate your bonus support there with the resources and also the active presentations that you'll be doing following this one in the industry. And just to add, in terms of key insights with our keynote speaker, Robert Prechter of Early Wave International, he shared latest insights on what he themed as levitating optimism in the stock market, aptly describing the historic level of irrational exuberance whereby sentiment will inevitably turn. Divergences across several key market proxies, coupled with key Elliott wave inflection points and related cycle timing, signal a likely risk from Q2 this year onwards, with markets like gold remaining bullish for now, but the broader direction of commodities remaining an open question amidst the polarizing forces of inflation and deflation. Quick word from me to enjoy the post-session bonus interview, which is done with all interviews, but it was extended with Mr. Prechter. We discussed potential historical rhymes of levitating optimism, including 1929, 1700s, and a millennia cycle reverting back to the Roman Empire. More to follow on that. Additional points of interest include his read on the four-year cycle and the presidential cycle ahead of the coming US elections and what social mood reactions to the Fed policy likely signal for markets. And of course, one of our most appreciative points is Prechter ending with an inspiring perspective on growth and importance of cycle analysis during times of uncertainty. So room for growth and interest in cycles ahead. Both those sessions by Jake Bernstein and Robert Prechter are now available on our FSC Cycle TV. Quick disclaimer for the presentations that you'll hear today that apply to everything we've covered so far. And a reminder of our speakers today, where we will kick off with FSC board member Bill Sarubbi, and then follow by Stan Harley, a technical analyst and cycle pioneer. A quick reminder to post your Q&A in the YouTube chat box, as you already have been doing, and just an encouragement to warm up throughout the session so that we can capture those questions and make sure we have an engaging and interactive forum. And now onto our lead speaker, Bill Sarubbi. A regular Forbes contributor, Sarubbi operates his own money management and consulting service. He was an analyst, institutional broker, and technical analyst on Wall Street, and a technology fund manager, North American strategist, and member of the Currency Hedging Committee with the Abu Dhabi Investment Authority, otherwise known as ADIA. Sarubbi is on the FSC Board of Directors, and great warm welcome, Bill. Great to have you here at the top of the new year. Happy New Year.
Thank you. Happy New Year, Ron. Thank you for that nice introduction.
Over to you. Feel free to share screen.
Okay. Let me just move this aside. Okay, I do not see the control that enables me to make this full screen. Okay, the Zoom panel is covering up what I need to see here. Let me see if
Bill, I think this is Richard at the bottom right there, kind of next to the Zoom, the plus and minus. There's a little kind of screen just to the left of that minus sign. I don't know if that would start your slideshow. Or you can go to the slideshow menu at the top of the screen there, and that should do it too. See the drop down slideshow menu?
The control to do that is at the bottom, usually at the bottom right, but it is being covered up by Zoom. And I am trying to move that. I'm going to put that up here.
Got it.
And it's one of these. It's
There
that
you
one.
go. You did
Okay.
it.
This is the January 2024 outlook. And as usual, a reasonable probability is the only certainty. So I think we're at an intermediate high in the market. And let me just give you the summary. I had the market from late October, likely to rally into January. There are several reasons for this. One of the most reliable cycles is that beginning with the midterm elections. It runs for 15 months. Now, if the midterm election was November of 2022, then this bullish effect dissipated in the first week of this month. January 3, as Paul McRae Montgomery used to say, is a natural turning point where the Earth reaches perihelion. Then there was a top in the 1-4 10-year cycle. I'll cover that in a few minutes. That peaked on January 8th. The end of the month bullish seasonality ended on the 11th, which is today. And the S&P monthly composite, we'll look at that, tops on January 16th. Now, let me just explain what the PTPs are. Those are projected turning points. Those are time counts from past highs and lows. I first learned this from George Lindsay in New York back in the early to mid 70s. And there was another PTP on 22nd. Well, the 15th, which is Monday, falls right in the middle of this. So I have picked that as a high, which means I'll be adjusting portfolios and selling off the leveraged long positions that I bought back in October. I'll be doing that tomorrow. I already started today. So Barron's 2024, you can't read why it's you can barely read it, but it gives a bullish message for 2024, and it's occurring right at this time in which I think the top will come in. So this is a contrary opinion confirmation. This is, let me move this thing again. This is 2023. That's the 1, 4, and 10-year cycle. I don't have the breakdown. I just have the composite. And as you can see, it did, the top came in about here. The composite said it would be the last week of August, but it did bottom right here, which is October 27th, is the annual low in any year anyway. So we had 2, 3, 4, 5 reasons for believing that would be a low. And here's the 1, 4, 10-year cycle. That's this cycle, but only in Q4. And as you can see, here's the low and this acceleration in December. So let's now jump up to 2024, looking at the same cycle. And for those of you who are not familiar with these cycles, the 1-year cycle, which you see in red, is the annual cycle of the year. The market rallies in spring into summer, tops down in September and October, also weak in June. So these are what I call static cycles, and that in that they do not change very much. The 4-year cycle is what's called the election year cycle. Actually, it's probably 3.86 years long. It is attributed to the Federal Reserve juicing up the economy in the year before the election, because the year before the election is the most bullish in this 4-year sequence. The year of the election is second strongest. The year after the election is the weakest. This is a good argument, but as my friend, the late Ian Notley, used to point out, there is a 4-year cycle before the establishment of the Federal Reserve in 1913, and there's a 4-year cycle in countries in which there's a 4-year election cycle, 6 years, 8 years, or no elections whatsoever. In other words, there's a 4-year cycle, period. The 10-year cycle is the decennial pattern of Edgar Lawrence Smith, in which years ending in 5 are usually the strongest, years ending in 7 usually bring corrections. And the most important observation in that sequence is years ending in 0, which have a net negative return. Now, down below, you see the summation of these 3 cycles just for ease, and you can see a top right here and a decline into late February or early March. So that's what the 1, 4, 10-year cycle suggests for this year. It suggests a weak opening to the year, a weak Q2, and then a rally in Q3 and the usual September correction, and then a strong Q4. So this is Q1. That's this cycle, the bottom summary, projected into Q1, and it shows approximately where we are now. And so this calls for a decline February into early March, but I have a reason to believe it will spill over into March. This is a dynamic cycle. This was run by my software. And let me just point out that these cycles are all based on the calendar year, of course. That's where you get the annual cycle from. And those cycles are ellipses, because they have to be, because the definition of a year is defined by the relative position of the Earth and the Sun, and the orbit is elliptical. The sine wave analysis assumes that all cycles are circular. So I look at both of them. And here you see a January 15th sell signal. And as you might remember, there is a projected turning point here on the 15th, January 15 PTP. So that confirms this one. This is the latest monthly cycle extracted from my own software from the S&P 500 data. And this now shows a decline through March, into the latter part of March. I suspect this is right, because the panic cycle, which I have not included in the deck here, peaks. It flares way up in March, which is a symbol of a bottom, everyone panicking and selling stocks for anything they can get for them. So I suspect we're in the beginning of a correction that will last sometime into March. And I won't repeat all of this. I've mentioned it all already, but I just wanted to recap it again. In other words, I'll be doing a lot of selling tomorrow, which is the 12th, the 15th being Monday. Now here's the daily S&P, which does not include the closes today or the previous day. And I think you may be rallying up to form a little double top, and then maybe pulling back to the 50% line, which would be 44.50, or maybe to 4,300. I don't think this is going to be a deep correction, because the problem is the technicals to me look pretty strong. Like new highs, new lows. This was from last week, and those numbers, of course, are a bit depressed because the market was weak. They're much more robust this week. But new highs over new lows has turned over the last couple of months, whereas it was negative all through Q3. And this market rally has been small thus far. You can see March 30th through January 2022, and then you see October 2022 through November 23, compared to prior bull markets. So this might just be a correction, and there really haven't been any major market corrections that started in years ending in 4 or in presidential election years. So here is the average Dow Jones Industrials January performance. This is from 1885 on the Dow, all months up 59.1% of the time. That's every January from 1885 to the present. In election years only, it's up 44% of the time, for an average change of a loss of 0.4%. Year ending in 3, up 76.9% of the time for a 2.2% gain. If we put both of them together, it's up 67% of the time for an average change of 1.1%. I think we're already at the high, and the last 2 weeks will not be that strong. So here's, I just did this recently over the weekend. The Dow rose by 12.5% in Q4. Here are the Dow results months after a rising Q4, a negative Q4 and a Q4 in which the index rose by at least 10%. So this is the percentage of months of January in which the Dow rose when Q4 was up. The next month was up 58% of the time. That's for all months from 1885. If Q4 was down, January was up 62% of the time. If Q4 was up more than 10%, which it was up 71% of the time. So you can see we've got a bit of conflict here. My resolution of this is I'm selling all leveraged positions probably tomorrow, but holding on to core positions like Costco and Intel and Nvidia and stocks that have been strong into this date. I just don't want to expose myself to risk in leveraged positions if the market is pulling back. So I think the pullback will probably be shallow. So this is the S&P in January. This is the expected return. In other words, the percentage of times it's up or down times the change. And you'll note that the early part of the month is strong. The second half, or the third part of the month is weak, and then it closes on the upside in the last week of the month. And that is the 2024 monthly histogram. All years ending in 4, of which there have only been 13. You see the number right here. And again, you see the Q2 is weak. July, surprisingly, is weak. And the last half of the year is fairly strong. So again, I'm coming up with something that looked like last year, except that instead of Q3 being very weak, it looks like Q2. And this is all election years, of which there are 34. And you can see that by the way, the red bar is the probability of a rise on that. Well, that's that month, it should say. And the blue is the average percentage change. And the green, which is what I favor, is the expected return or the product of the first two. So you can see that the strongest month here is August, followed by a weak September, October, much like what we had last year, and then a strong November, December. So it looks to me like we are going to be fairly flat in the first half of the year putting this together. If I'm correct about a decline into March or a trading range into March, Q2 doesn't look like it's very strong or highly volatile. So it'll be very good for traders. I don't think it will be good for buy and hold long only fund managers. Now there's the 2024 monthly histogram with both years ending in 4 and election year factored in, of which there have only been 6. And so you can see pretty clearly here that April, May are pretty, but here June is strong. So you see there's a great deal of variability. Q1 fairly weak, mostly centered in February and March, and then Q2 very volatile, which means I don't think it's going to hit a new high. But we may very well have new highs in the second half of the year, particularly in Q4, which is when we get 60% of all S&P profits anyway. So as for sectors, this is a relative strength ranking, which is unique because it's based on time periods that have been optimized. And as you can see, communication services is number 1, technology is number 2, not much different from what we've seen most of the year, but financial sector has risen dramatically suddenly. And the energy sector is way down there at the bottom. I don't foresee much recovery. I see recovery in the oil price, but these are the energy stocks. I don't see recovery. We're going to go into that. You'll see why. Consumer staples. During periods of inflation, food companies are unable to raise prices very much. I know because I was the food industry analyst at Value Line in the 70s, which is the last industry you wanted to be covering in an inflationary period. They couldn't pass price increases on to customers, and their margins got squeezed. I don't think that's going to change either. I don't think utilities are going to rally very much. So I think this relative strength listing will stay relatively unchanged. Now, this is, for right now, these are the strongest stocks up at the top, ranked by seasonality and relative strength rank. Advanced Micro Devices comes in number 1. I can't really argue with that too much because it is in the chip industry, which has been hot. The stock has been hot. Then PHM, which is Pulte Homes, then Intel, BXP, I forget what BXP is. CCL, of course, is Carnival Cruise Lines. Then we have Micron, Citigroup, Western Digital, Lennar, and other. So you've got a lot of chip stocks in here. I see LRCX, which is Lam Research. So I see here a lot of building stocks and a lot of chip stocks. Now, here's the other end of the spectrum. McKesson, number 1, Expeditors. There is Starbucks, which I think will report negative earnings based on short-term cycles at the end of this month and is a short. And AutoZone, Procter & Gamble, which is a very weak stock. I'm surprised it's not even lower. Then you see Philip Morris, Hormel, PepsiCo, Yum. You see a lot of food stocks here. Remember, as I said, they cannot pass their price increases on too much. And so Nike is down here also. And with Nike and Starbucks, I think people are going to have to cut back and save a few pennies here and there. And so I think that's the fundamental driver behind those. Now, oil is nearing its, now this is oil, the commodity, not the stocks. Price has risen 77.5% of the time from March 20 to May 21. We're not even at March yet. But you can see January is kind of flat. The probability of rise is over here. So this is saying there's about a 50, a little better than even chance that oil will increase in January based on 41 years of data. Now here we see it rises closer to, it rises over 60%. Let's call it 62 in February. And then it rises yet again here in March to a 63%. And then it hits a peak here in April. And the blue bar is the percentage return. The green bar is the red bar times the blue bar. The expected return, as you can see, is the highest in April. So that's what I mean when I say we're entering a seasonally strong period for oil. And October, November is the Bermuda Triangle for oil. It very really, no matter what test I've run before this, like the percentage change coming in, the seasonality coming in, the condition to the indicators, it's very weak, only up about 37% of the time in November with a negative expected return, and then up about 43% of the time in October with another negative return, expected return. So, and the oil cycle is choppy. So right now we are just about here, about to give a buy signal. Well, let's go back here. So we're approximately in this area. And the dynamic cycle, this is a dynamic cycle because it is extracted from the most recent data. This is a static cycle because it stays relatively unchanged over the years. So I do have a long position on oil, which I'm going to hold and maybe even add to because I caught this low back here with shorter term methods. But if you've got, that's January 14th, we're only a few days away from that. So in fact, in trading days, it's only today. And well, this is over the weekend, so one trading day left. So I'm hanging on to a long oil position right now. Now, this is quarterly oil from 1880. And I don't know what this tells us really, but we had a good rally up here. We had a pullback and stopped right at 61.8% and have rallied back up. Didn't quite get to 100% retracement of that prior decline. And we've pulled back now to 23.6%. And this is quarterly oil. So I could get the entire price data on one graph. And you'll note, as far as momentum goes, we're not even up at the zero line yet. So this is essentially the momentum is, it's not overbought, despite this rally from here, which covers several years. And so I am bullish on oil. And the fundamental is, of course, the American administration's war on energy, which is not helping the producers very much. Now, here's monthly oil. This is monthly from 18. It's actually, that should read from 1982. And I threw in some Fibonacci retracements just to see where we are. And you'll notice this green. Here we go. We're right in here. We're at about a 50% retracement of the last move, of this move from here to here. So I don't think oil has much downside. And now here's the oil stocks. This is based on the XLE. This is not the commodity. This is the equity stocks, the equities, the stocks dropping in relative strength. Relative strength is a key indicator. This is relative to the S&P 500. If that line is dropping, that means the big boys, like down in Abu Dhabi, they are selling these stocks. And you're not going to win that battle. And you'll note we're up against a downtrending resistance line, and momentum doesn't look too great here. And you see lower highs in momentum here. So I doubt very much that oil stocks are going to follow the oil price up. So I would stay out of energy. Now, gold, that's just the last daily close. There was a hook buy signal way back here in October. And this is on a monthly basis. So it went to a new low, then closed at a new high over the previous month. So to me, this is a fairly monster buy signal. And let's look at the seasonality. And the seasonality, sorry for the blurry slide, this is based on gold from 1861. And you'll note that January is strong, whether you take the gold price from the 60s or you take it from 1861. January is still the strongest month. In other words, there is a consistency to the seasonality in gold. And still, March is still down, whether you use the data from the 60s or the data from 1861. So right now, January, February, gold looks strong. I have a target of 24 to 2,500 on it. And we've got until I think late February to get there. And March, given the underlying technical strength and what I think the fundamentals are, which I'll speak about in a minute, I think March may only be a correction or a sideways consolidation because this is followed by two seasonally strong months. So these are the static cycles in that they do not change very much. Now there's the dynamic cycle, and you see it's going straight up. And I'd like to state that I think the fundamental situation, the state of the banking industry, and so on, are becoming so shaky that there's a flood out of paper assets into gold and also to Bitcoin. And I had stated a while back that I didn't think anybody serious would invest in Bitcoin until the regulators came in. And of course, we just had the approval of the ETFs. But I'm also reminded of way back when they legalized gold holding in the United States. And gold, I think, ran up to 190 something dollars an ounce. And right around the time gold ownership was legalized, we had a big correction of about 50%. In other words, the buying in Bitcoin may be at an emotional peak right now, and there may be a pullback. I remember that very distinctly in gold, but in gold currently, I do not see that. I think it is going higher. And by the way, the largest real estate company here in Austria just went under about a month ago. I'm trying to think of the name of it. It's got the same name as a US company, but it's spelled differently. So, speaking of a real estate company that went broke, we have many times at the foundation shown the 18-year real estate cycle. In particular, the book, The Secret Life of Real Estate and Banking, which is right behind me on the shelf. And so here is San Francisco condos, price per square foot. And as you can see, the price per square foot in San Francisco, which has been an exceptionally white-hot market, is declining. And that's by Phil Anderson. I was trying to think of the author's name of the book, who brought this back brought it back from the dustbin of history to publicize it. It's worked. The amazing thing is about this cycle is it's 18 years long, and it's so regular, and yet people don't seem to heed it to this day. Now, here's Chinese property stocks from this high up here in 2019 are back at the lows they last saw during the crisis in 2009. And back in my own hometown, Manhattan medium rent hits $4,312 in September 2023. I left Greenwich Village in New York and moved to Abu Dhabi in January of 1990, and I was paying about $280, $300 a month for my rent in a beautiful brownstone in Greenwich Village. It's now, the median rent is $4,300. And here's U.S. new home prices activity. It is down this is U.S. new one-family houses sold annual median year-over-year price change. It is back where it was way back, if you remember, 70 to 74, which was a real low. So this is going to hurt the economy fundamentally. When the market is going to react to it, I do not know. I don't think it is going to be this year. It may be the year after, because then we would be in the year after the election. So this situation reminds me of the 70s, in which rates went well over double digits. And I do think rates are in a longer term bull market. Equity markets fell and the economy suffered. Investors sold stocks for less than they paid because the market topped at about 1,000 in late 69 and bottomed in December 74 at around 500 on the Dow, 50% loss. And the resulting cash that you raised, if you sold your stocks, the purchasing power had greatly eroded. So this was a period of very real wealth destruction. And real estate was in a recession as forecasted by the 18-year real estate cycle. So that's where I think we are now. Plus that we had what was perceived as a weak presidency and trouble with Iran. And you can see these things repeating right now. So you wind up, because this is like a cold front meeting a warm front, it creates odd situations like the rare 1914 Babe Ruth card just sold for $7.2 million, something in the last month. Now, this is not the highest. I think that was $12.6 million for a Mickey Mantle card, which would make Yankee fans happy. On one hand, you have this. On the other hand, you have this. Bankruptcy filings rising. U.S. Chapter 11 bankruptcy filings, as you can see, bottomed in 2022, and they've turned up. So on one hand, you have people who can spend millions on baseball cards, and on the other hand, you have bankruptcy filings rising. And this makes sense if you study Austrian economics. There's simply too much credit around. Too many people have been lured into businesses or have taken on too much debt or secondary mortgages, and they're not finding that there's a way to get a return on those funds. And so bankruptcies are rising. And now these guys, I had to mention, I always like to call out people who are correct. The Business Week bestseller, Dow 36,000, the new strategy for profiting from the coming rise in the stock market by Glassman and Hassett. These guys were certainly right, and I had kept a copy of this as the Dow rose, wondering if I would ever present it to people and I could say, hey, these authors were correct, but they were. So, and now this is, there's something extra I put in here. There was a lot of publicity or a meme about going woke and going broke. Budweiser got hit by this. Target got hit by this. Disney especially got hit by this. So in my software, I created a way to compute an equally weighted index of these stocks, and I call it the woke index. And the woke scare apparently ran off, dissipated or wore off very quickly. So here you can see the Cycles Research Woke Index, which is just an equally weighted index of Budweiser, Delta, Cracker Barrel, JP Morgan, Target, and Disney. I could probably throw a few other companies in there. But this woke index fell 20% versus a 10% loss for the S&P 500 during the correction in Q3 running into 4. And since the low in October, up 27% versus a 15.9% return for the S&P 500. So I think what happened here was, boo, there was a fright. And then people began to realize that down here, that the value of these companies have been depressed far below their fundamental value, that fundamentally Delta, Budweiser, Cracker Barrel, JPM, they're all intact, the fundamentals. So why not buy it? So Go Woke, Go Broke, not exactly was the title of my article in Forbes on Forbes.com. And so that is my presentation, and I'll take any questions.
Ron, you're muted.
All good. Sound clear?
Sounds good.
Thank you. Unique insights as always, Bill, and I was just complimenting the broad range of cycle signature work that you've used for years, and of course some interesting headline talking points. So I'll kick off with a brief recap, just to help for review and conversation. Correct me at any point in time. Equity rally into Jan, back end not too strong, but a Q1 likely to be corrective. Panic cycle into March, which could lead to a selling climax. Environment good for traders, but not so much for buy and hold money managers. There's a question on sectors, whether you were proposing defensive sectors as a good buy at the moment? You had a sector list out there.
No, no, I still think I still think the leaders will remain in the lead, but I don't think the energy sector and consumer staples are going to rally.
Okay, thanks for clarifying. And then on oil, very interesting in terms of the strong seasonal period. The fundamental reasoning in terms of the war on energy as being well, strong and likely supportive. Gold still strong with a target for 2,400, fueled by ongoing saving flows. And your comment about financial stress maybe broadening out this year is interesting. And then just at the back end of my comments, the 1970s historical analog sounds very interesting. I noted you mentioned double digit for rates, stocks selling off, and that kind of disruptive geopolitical environment.
That sounds like it.
Good. If we could kick off right at the top, Bill, for people who may be looking at your work for the first time, or maybe just refreshing and doing a deeper dive, could you run through the 10-4-1 cycle framework and
Sure.
what each of them signal here and now? Because it's a great platform for your view ahead
Yes.
of the year.
Well, the first one I became aware of was the 1 year cycle way back in the late 60s, early 70s, when I read Arthur Merrill's book, Behavior of Prices on Wall Street. And he was the first guy to actually sit down with a calculator, no computers then, and figure out that stocks were stronger on Friday than they were on Monday, and how the seasonality worked and how the market behaved around holidays and things like that. So I got very captivated with that. And back in the 90s, our old friend Richard Mogi was head of the foundation for 8 years. And one day I said to him, Richard, is it my imagination, or when you're starting analysis of a new market, you start with the 1 year cycle? And he said, that's exactly what I found in the last 20 years. You start with the 1 year cycle, you would think you would want to start with a 10-year cycle or 20, but actually, I start with the 1 year cycle. And for example, if you are going short, as one of the traders said when he explained this to me, never go short in Q4. That's like eating soup with a fork or running up the down escalator. You're going completely against the cycle. So that is static. It stays. I'm trying to measure variations off of that. And then you have the 4 year cycle, which has been attributed to the Federal Reserve, that they juice the market up. They issue extra currency into the economy in an attempt to lift everything and make it look optimistic to get the president reelected. But as our friend Ian Notley pointed out, this phenomena existed before the establishment of a central bank in the United States, and it exists in countries all around the world. And the 10 year cycle was developed by Edgar Lawrence Smith of Ameritrust Bank back in the 30s. And he said years ending in zero had the worst returns. That's certainly true. I've used that to my advantage a very large number of times. Years ending in two have seen the most stock market lows, the ends of bear markets. So now, in terms of months, October has seen the greatest number of lows. So therefore, October's and years ending in two are most highly likely to be bottoms. And years ending in five have the best returns. Years ending in seven have usually brought some sort of financial crisis, 1987, 1997, 2007. And the end of the year, the last year's 8 and 9, they generally bring higher indices. So right now we're going into a year ending in 4, and if the year ending in 2 was a low, which it was in the month of October, then generally we haven't seen any big market shakeouts in years ending in 4.
And then just reading the chart there visually, it looks like the 10-year topped into the start of this new year. Is that correct?
Yeah, that's correct. But this is the easiest thing to start with. But if you think about them, and I was just at Stevens Institute in Hoboken, New Jersey, one of the best engineering schools in the world, and the QuafaFew, the quantitative group, met there. And so I went, and so the one professor said, I've seen your name, but we've never met. So we got to know each other, and he said, well, what kind of work do you do? And I said, well, I work on things like Arthur Merrill and the monthly seasonality and the end of the month indicator. And he said, I'll believe in that if you can tell me why it happens. And that's that's where it stops with quantitative people and funds. They want to know why it happens. And I'll quote the late John Nelson, who got a telescope, went up in the top of the RCA building in 1949, and figured out that shortwave radio communications were disrupted when the planets were in certain angles, Pluto, Uranus, even the outer planets. He started it out based on gravity, and he didn't take into account the outer planets. When he did, he got 95% accuracy because the RCA Corporation wanted to know when there were magnetic storms on the sun that would disrupt shortwave radio communications in the 40s and 50s, because obviously we didn't have satellites yet. And so Nelson was lecturing in New York, and somebody says, "Sir, why does all this stuff work?" And John, who was about 70 at the time, said, "You want to know why it works?" So I don't know why it works. And when you go to the pearly gates, ask the Grand High Marketing Muck, and he probably don't know either. So that's my answer. Right, so if it works, I use it. And I can tell you right now, I've been in the biggest institution in the world, and I've been, with PaineWebber or Value Line, and none of them. We don't do any market timing. That's saying I don't want to put in the effort to do any market timing. I'm going to pick stocks. But Benjamin King's PhD dissertation, U of Chicago, 1965, 10% of all the movement in any stock is associated with the individual company, 20% with its sector or group, and 70% with the overall market. But these guys don't want to look at the 70%. They're looking at 10 to 30%. And I think that is the single biggest reason for underperformance in big funds.
That's a powerful point, Bill. And I recall that you had a slide for that in previous sessions. A point that I'm sure people will remember and take note of, particularly in terms of cycle application. And one question I had to follow up on your framework, this year being the election year, a question that was shared with our keynote speaker, Robert Prechter. What's your perspective given the nuances of this election? So we've got Fed policy unwinding for now, or at least the market perception. Plus, you have this polarization in terms of presidential leaders, which have less firepower than historically is the case. So, how does that impact the presidential cycle, if at all?
Well, the only thing I can say is I'm still politically looking at the world situation, and I think it is somewhat likely we make it some sort of whether it's a climate lockdown or something like that, beginning somewhere between now and let's say August. Like we had a COVID lockdown before the last election. So that's the one wild card in that I really can't account for.
And just to add to that list of wild cards and tail risks while we're on topic, I noticed your point on oil, finding a base and likely upside risk ahead, and the point about the war on energy. Would you add kind of various kind of broadening geopolitical premium, the so-called kind of Red Sea risk and whatnot as a potential factor?
Yes. Yes, well, I lived in the Middle East for 13 years, and I still, go down there occasionally. I talk to them about every month or so. And the odd thing is, Abu Dhabi is leading the world in sequestration of taking the harmful elements out of oil so it burns very cleanly. And so, what is the climate argument then when they succeed with that? And they're working on it right now.
Okay, and then just additional questions from our audience. Market specific. So Lee is asking, what is your view on real estate bottom in the US in terms of timing?
About 2 to 3 years from now.
Okay. And we have Sejong asking, what do you see the bottom for stocks this year, late March or perhaps July? So you mentioned that panic cycle into March. Thereafter?
Well, the panic cycle, it usually occurs if people panic, and it just happens to flare up in March and then drop. And March is when some of the cycles, it's either February or March, and because of the panic cycle peaking in March, I'm guessing that the low is going to be sometime in March, and the market may lose like 5 to 10%. I don't think it's going to be a deep correction, because I think there are a lot of very positive. Part of the problem here is if you just follow the cycles, you'll do okay, but you have to factor in the fundamentals. So if stocks are very cheap and cycles are turning down, where are they going to fall to? And the young people don't believe me today, but at the market low in 1974, the average PE ratio was, I think, 4. And when I went to Value Line in 1977, the average PE was 7. And so if you had a PE ratio of 10 or 15 in the 70s, you were overbought. And look at that today. So it's relative to what's happening in the market. And from what I can see, momentum and very short term, when the market sold off in the first week of January, a lot of what you might call the unprofessional money fled the market immediately and turned bearish. That is not irrational exuberance. That's that's like the soldiers see Napoleon's Imperial Guard coming over the ridge and they drop their muskets and they run away. That is not a very bullish sentiment, I don't think. I watch these things pretty closely.
And then an additional question from William on cycle application in terms of peaks versus tops in cycle prediction. Some cycle experts say that the cycle bottoms are more predictable than tops. What's your take on that?
Well, tops are more diffuse, whether it's cycles or technical indicators. Lows, I mean, how low can you go? Minus 100%. That's it. How high can you go? Well, what would have happened if you bought Microsoft at their inception way back when? Is there any limit on the upside? No. So that is true. And most lows occur in October. And I've told this story before, but I was in the NYU library at Washington Square years ago, 69, 70, 72. And I found a book covered in dust. It was the Statistical Journal, the University of Manchester, dated 1890. And then there was a study in the reserves of the Bank of England for the previous 50 years, in other words, 1840 to 1890. When did they hit a low? And showed a little graph in October. And the rationale was it is an agrarian economy, and that's when all the crops are in and the winter starts. And so this business that when you look for lows, you look at October, and putting the decennial cycle and the 4-year cycle together, the decennial and the seasonal cycle together, most lows will occur or are most likely to occur in years ending in the month of October. And September is down a good deal of the time, so is June. And the way I used to use this, I ran the technology portfolio, and technology usually declines August 15th to about October 15th. I would lighten up and buy something else like automatic data processing or paychecks, because those stocks had the strongest months at that time. So that's how I was using the seasonality just to add basis points. And you have to remember that if your rival on the other side of town or across the street is not doing what you're doing, you're gaining basis points on him. So that's one way I use cycles.
We'll follow up on markets from Eric just as we close. He wants to know your view on rates. Do you have your view, but also do you have a target on rates? You mentioned double digit in terms of the 1970s analog. Could this time be different, similar? How does it rhyme?
Well, right now, I think the month of January, the cycles point up for bonds, which means down for rates. But I think as the year progresses, we're going to see shift, and we're going to see rates going higher. And I think, over 5 to 6 or 7%. But I think that's going to take a year or two. And, it's a different from the Austrian School of Economics. In August 71, Nixon cut the gold dollar link. But in June of 80, Jimmy Carter signed the Monetary Control Act, which means they can monetize everything. They can buy all of our credit card debt and put it on their books as an asset. So they can monetize anything. So if you can create an almost infinite amount of money, where a price is going to go. So this really complicates the picture. And if they can do that, I think they can force rates down better now than they could 50 years ago.
That's a great point, and it just emphasizes just how challenging it can be in this dual force environment where we can get inflation, deflation, bounce of both.
Yes.
Thank you so much, Bill. Splendid presentation as always, and grateful that we could have time for Q&A. Thank you.
You're welcome.
We'll switch to our next speaker, Stan Harley. Just one moment. I'm just going to change slides. One moment. Welcome, Stan. And the official intro, and then I'll pass back to you. Stan Harley, the technician, a cycle pioneer, and author of the Harley Market Letter, employs advanced technical analysis of the stock market, bonds, precious metals, and more. Since 1995, it has been ranked 4 times by Timer Digest as Stock Market Timer of the Year and Bond Market Timer of the Year. Harley's work has been featured in Barron's, Investors Business Daily, the Los Angeles Times, technical analysis of stocks and commodities, and other national media and publications. Stan, we briefly chat as part of the master working group at the FSC. Always an honor and a pleasure. Looking forward to your presentation.
Thank you, Ron. I am thrilled to be here.
Over to you.
I've been an avid cycles practitioner for about 40 years. I was originally introduced to the foundation when I lived out in California in the 1980s, and at the time the foundation was located in Irvine, California. That's in the Los Angeles area, and that's where I lived as well. And we held monthly meetings, lunch meetings, and dinner meetings there, and it was just very, very informative and enlightening for me. The director, when I first joined the group, was Jeff Horowitz, and then later Richard Mogi took over. I was kind of a cycles skeptic until early 1990. We had a luncheon meeting, and Richard was showing his work, his cyclical work with war and battles. And he had data going back several thousand years. And his work pointed to a major war beginning somewhere in the world in about August of 1990. And this was maybe January or February of 1990. We all kind of looked around at each other and went, okay, fine. Well, guess what? August of 1990, Iraq invaded Kuwait. And there was, of course, the big Iraqi war. And I just suddenly became a cycles enthusiast from that point on. And of course, I've been interested in financial markets for a long time. So that piqued my interest, and I delved into it head first. And I'm going to present some things today I think the viewers are going to find very informative. If you've got a Diet Coke or a cup of coffee here, I'd take a swig, because we're going to get right into it with a lot of numbers and a lot of data. Tell you briefly a little bit about myself. I have a Bachelor of Science degree in aerospace engineering from the University of Texas. I have a master's degree in operations management from UCLA. Right out of college, I went into the Navy. I was a naval officer. I was a Navy pilot. I flew the F-4 Phantom, the F-14 Tomcat, and the F-18 Hornet off of aircraft carriers. After the Navy, I worked at Northrop Grumman Corporation, an aerospace company out in California, for a number of years in their pilot vehicle interface and design center. And in the early 90s, I got out of the aerospace world and got into investment management. Got registered as an investment advisor in California. And in 1995, I started publishing the Harley Market Letter. And I've been doing it continuously ever since. Because I'm trained as an engineer, my mindset is as an engineer, as you would expect. I am not one to believe that markets are random or cycles come out of heaven. I believe there is order and there is random. There is not randomness here. There is order. There is mathematical order to everything that we see. The challenge, of course, is to sit down, wipe off your glasses, look at the charts, pore over the data, and try to uncover the math that defines how markets move. And that's what I've made my career all about doing. Here's a shot of me climbing up the ladder into my F-14 Tomcat. That was about 40 years ago. Here's what we're going to talk about today. As an engineer, those of you who are engineers, very early on in your training, you learn about kinematics. What is kinematics? Kinematics is the study of motion of objects without regard to the forces that cause those objects to move. So we look at a ball rolling across a table. We don't care how or who pushed it or why the ball was pushed. We just want to study the motion. Well, I do exactly the same thing in the markets, and I call the study of technical analysis and the type of discipline that we're all involved with, I call that market kinematics. Meaning, I want to study the price motion on the graph. I don't care why it's moving, who moved it, or any of those other things. I just want to study the price motion on the graph, and I want to try to model it mathematically to the best of my ability. I have made a lifetime study of Fibonacci and Lucas relationships and their ratios, and we're going to get knee deep into that stuff here in just a moment. Cycles have different forms. They're all defined by mathematical functions. There are different types. There are fixed speed cycles, there are variable cycles, and there are change in trend cycles. We're going to look at the stock market. We're going to look at interest rates. We're going to look at precious metals, and we're going to look at Bitcoin. I was a guest analyst for a number of years out in Los Angeles on KWHY television, channel 22, which was really the forerunner to CNBC and Fox Biz and Bloomberg, everything you see today. The original financial news station in the country was in Los Angeles. And I had the good fortune of being invited on there as a guest analyst. There I am with Richard Saxton, who I think is probably one of the best, if not the best, newsmen with respect to knowledge about the financial markets. Just an outstanding gentleman. There are essentially three disciplines to approaching the markets. The first is fundamental, which we all hear about every day. You flip on the TV, pick up your newspaper. The total focus, or certainly the vast majority of the focus, is fundamentally oriented. That is to say, analysts, money managers will look at a company, or they will look at the market overall based on earnings, PE ratios, products, services. What is the Federal Reserve doing? What are the politics? That sort of thing. I don't pay much attention to that, or maybe I should say I pay very little attention to it. I pay scant attention to it. I'm first and foremost a technician. There are other disciplines that try to analyze the markets. That's a quantitative approach. For those of you who may have MBAs, will know what I'm talking about. What I got drilled into me in the MBA school at UCLA was doing multiple regression modeling. And so what MBAs do when they go to work for large companies, if they want to try to forecast product flow or how advertising works or where to deploy various resources, they will build very large mathematical models and assign weighting functions to those models, and then turn the crank on the computer, and then out comes the answer on the right end. And there's a lot of folks that do that process, a lot of big folks with major Wall Street firms that use that approach with respect to trying to forecast the financial markets. I'm not a big fan of number one or number two, as you might know. I'm a big fan of number three, and that's technical analysis, market kinematics. What I say is all of the information that's out there is available in the tape. Price charts, the indicators, the cycles, the price tells us everything we need to know. Numbers. the way markets move, I believe, is defined by the math, by mathematics. And I think those folks who try to approach the markets or convey the sense that the markets are simple or can be tackled simplistically, I think are doing a grave disservice to the people that they serve and to themselves. I think the markets are, in fact, quite complicated. Does it mean you and I, everyone here on this Zoom meeting, can't figure it out? But I do believe they're quite complicated. Let's start out with a term that probably most of you, but maybe some of you may not be aware of, and that's Fibonacci. In the beginning, there was this Greek mathematician named Euclid, and to the best of my knowledge from my research, he was probably the first one to examine what today we call the Fibonacci ratios. But what he wanted to do was try to find the mathematical relationship between two sets. One, a line of length 1, and another line that had two separate lengths, x and 1 minus x. And what he wanted to do was try to determine what was the ratio such that the line with length 1 relative to x would have the same ratio as x is to 1 minus x. Well, one can construct an equation, as I have shown you there, and with simple algebra 2, it develops into a quadratic equation, and the positive solution of that quadratic equation is the square root of 5 plus 1 divided by 2, 1.618. And of course, the inverse of that, the square root of 5 minus 1 divided by 2 is 0.618. But that's kind of the crux of Fibonacci ratios and how we get started on this path. There are a number of other Fibonacci ratios that have mathematical derivations, and I'm going to show you that here in just a moment. But these are the primary ones that I work with. Of course, 0.618, 382, most of you are familiar with, 236, 146, and then we get down in the smaller numbers, 090, and then 1 minus those, 0.618, 0.764, 854, and so forth. There are a few other ratios that tend to show up now and then, 0.191, 0.309, and the inverse of those two, 0.691, 0.809. What you see on the page are probably 98, 99% of the Fibonacci ratios I work with, and they pretty much stood the test of time. Now, the Fibonacci sequence, not to be confused with Fibonacci ratios, were probably first discovered by some Indian mathematicians in about the 2nd century BC. They were not widely known, certainly in Europe, but a young man from Pisa, Italy, in the early 1200s, traveled to the Mideast with his father. His father was the customs inspector for the Italian government. So he traveled with his father down into the Eastern Mediterranean basin, and he found a lot of the traders were working with these numbers, 1, 2, 3, 5, 8, 13, and so on. And he was quite fascinated by them. Went back to Italy, of course, and in later life, as a mathematician, he recognized that the Roman numeral system, which was then in effect and use, widespread use in Europe, was inferior to the Hindu-Arabic system, which contained 9 digits plus 0. Roman numerals did not have 0, and they were too clunky to add, subtract, multiply, divide, and so forth. So he wrote a book called Liber Abaci, published in 1202, in which he said that the Hindu-Arabic system was superior to the Roman numeral system. And in the last chapter of that book, buried in the back, he had a little section on what he called the rabbit problem. And he explored the use of these numbers that he learned while traveling with his father. He did not understand the math, but nevertheless, he mentioned the numerical sequence. And that is how Europe got exposed to not only the Hindu-Arabic system, but the numbers which later bear his name. Not a whole lot was done with them for a while, but there was a French mathematician that I'll get into in just a minute that popularized both the ratios and the numerical sequence. For those of you who are interested in the formula that defines Fibonacci numbers, if, for example, you wanted to know what the 10th Fibonacci number was, well, rather than sitting down and counting them either by hand or on your computer, there is a formula. If you want to know the 10th Fibonacci number, you take 1.618 to the 10th power minus 0.618 to the 10th power and divide by the square root of 5, and that would give you the number 55. And you can do that for any Fibonacci number. Not a lot was done with this until a French mathematician, Edward Lucas, and that's the anglicized pronunciation of his name. He published a book on periodic functions, and he did a couple of things. He found that Euclid's ratios and Leonardo of Pisa's numerical sequences were related. And he gave Leonardo of Pisa the name Fibonacci. And so that's where Fibonacci comes from. It was from Edward Lucas. He also found a secondary series of numbers, which now bear his name, the Lucas number series, and I put the formula there on the page. But until Lucas published this information, it was not known that there was a relationship between Euclid's ratios and Leonardo's numerical sequences. Edward Lucas made that connection. And here are the Lucas numbers. I would imagine not many of you watching this broadcast are aware of Lucas numbers. I find in the literature scant discussion of Lucas numbers, even among financial professionals or people that get into the blades of grass like I do. A lot of people are well aware of Fibonacci, but I have found that Lucas numbers are probably more important than Fibonacci. I kind of clump them all in the same group and refer them as Fibonacci relationships. But Fibonacci numbers and Lucas numbers are two different sequences, and by far and away, as you're going to see in the coming slides, I have found that a knowledge and a solid understanding of Lucas numbers is far, far more powerful and more important. What I've done here is I've constructed a table, and in the left-hand column, I've got the Fibonacci numbers 5 through 610. Second column are the Lucas numbers 7 through 521. And then what I found just one day, when I was sitting under the apple tree and the apple fell on my head and bonked me, I found that if I doubled these numbers and multiplied them by 4, my gosh, these numbers showed up a lot, and I mean a lot in the markets, time and time again. Didn't matter which market, didn't matter which time frame, but the numbers you see on this page show up time and time again. Fibonacci numbers, I have found, tend to work best in defining time periods between lows to highs and highs to lows, the diagonal moves of markets. Lucas numbers do a far superior job in defining time counts from high to high or low to low, i.e. the horizontal movement of markets. Market cycles, I believe the vast majority, when I say the vast majority, probably 99% of cycles probably have their root grounding in Fibonacci-Lucas relationships. Maybe multiples or maybe adding some together, but the vast, vast majority of cyclical functions, I believe, have their root grounding in what I call Fibonacci numerology. And I'm going to show you a number of examples why I believe that to be true. Here are the Fibonacci numbers down the left side. And what I found is if I take the Fibonacci numbers and I divide by the square root of 5, I get another set of numbers. For example, 55 divided by the square root of 5 is 24.6. If I double it, it's 49.2. And then the ×4 column is on the other side. But these numbers on the ×2 column, i.e. 89, divided by square root 5 times 2, 79.6, and so on. These numbers also show up time and time and time again in the markets. And I'm going to show you several examples. Here's a kind of a summary table of everything I've just shown in the prior sequence of slides. I keep this printed out and taped on my wall here next to my computer monitor. Down the left side, I have the Fibonacci series, 5 through 2584. I have the Fibonacci series multiplied by 2, by 4, and by 5. The most important thing are the left two columns on that graph. And then over on the right side of the graph, I have the Lucas number series from 7 to 2207. The column to the right of that, I take the Lucas numbers and I multiply by 2. And oh my gosh, that column is probably the most important column on this entire page. And then I also multiply Lucas numbers times 4, and they secondarily show up as well. And then the equivalent function from the prior chart, where I take a Fibonacci number, divide by square root 5. You can also take the Lucas number, multiply by 2, divide by 5, and you get exactly the same numbers. 49.2, 79.6, and so forth over on the far right of the screen. So the takeaway is the numbers you see in front of you, these are the numbers that I see time and time again in the markets. All markets, all time frames, they seem to be the defining mathematical functions that define what you and others might think would be randomness in nature, randomness in the markets. And I'm here to tell you they're not random. The price movements are not random. They don't fall from heaven, but they are defined by mathematics. And the primary mathematics for defining these price movements are right here in front of your eyes. This is, after all, a cycles-based organization, and I can tell you from my 40 years plus experience in this business that it is just mandatory that we understand cyclical functions to understand how markets move, why they are moving, when they're going up, when they are going down, the top level functions, cyclical functions that are dictating the market direction, and the lesser functions. So I start with looking at yearly data, then I look at monthly data, then I look at weekly, and then I look at daily, and I take it down in that order. And boy, I so agree with Bill Sarubbi on this point when he pointed out that stocks are influenced primarily by the broad market, then the sector, and then last but not least, the actual fundamentals of the company involved. Why these Wall Street analysts spend so much time on the latter when that contributes so little to the stock movement, and they pay scant attention to the overall market is beyond me as well, but it is what it is. Having been aware of that, I think that gives the rest of us, I think, an edge. I think a big edge. These are the mountains in the state of Virginia where I live and where Richard Smith lives. I think it's a beautiful state. I just moved here recently. Okay, let's take all this book knowledge that we just compounded and let's see if we can apply it to the markets. I'm going to focus primarily on the stock market. We're going to look at some other markets as well. But it's my belief, based on the charts that I'm going to show you here shortly, that we are getting very close to what I think is going to be a major secular market peak. The stock markets in the capitalist world today owe their beginning to a Dutch businessman. His name was Johan van Oldenbarnevelt. And if there are any Dutch speakers on, I apologize for butchering that. He formed what was called the Dutch East India Company. That's the anglicized version of it. But what he did, the Dutch at the time, in the early 1600s, were the preeminent power in terms of trading across the Atlantic Ocean and to India and to South America. And they were gradually displacing the Spanish. Spain was more involved in the Southern Hemisphere. The Dutch were very, very actively involved in trading not only with North America. They, by the way, founded New York, which was at the time called New Amsterdam, settled in Pennsylvania, New Jersey, all of the northeastern United States. And anyway, this gentleman built the Dutch East India Company and was franchised by the government to basically have a monopoly on the trading rights. He then sold shares to other business people in his company and created the first stock market. So the stock market began on March the 20th, 1602. That is the genesis point for all the world stock markets. The British saw what the Dutch were doing, and in 1698, the London Stock Exchange was born, and they essentially replicated what the Dutch were doing with all of their companies. And it's been just a grand method for providing financing to companies to expand in what they do. The Dutch started 1602, the British market started in 1698, and the US market started in 1790 under that famous buttonwood tree, and now what is now the corner of Broad and Wall. This is a synthesized chart of the S&P 500 going back to that first day in March of 1602. I am very fortunate to have this data. It was compiled by Richard Mogi, who was the former director for the Foundation for the Study of Cycles. He had some help. Brilliant man, fine gentleman, very knowledgeable in the area of market cycles. And of course, he induced me to become a cycles practitioner. But he scoured the universe for data in Amsterdam and London and, of course, New York. And what he did was he synthesized those three markets and created a synthetic chart of the S&P 500, and he also did it for the Dow Industrials. He completed his work about 4 years ago, and he and I corresponded a lot, and he sent it to me asking me to scrub it and analyze it, which I did. It was my plan to go back to his home in Tennessee and roll out my chart work on his table. And very unfortunately, of course, as you all know, COVID hit, and Mr. Mogi, unfortunately, contracted COVID and did not survive, and we lost him. Very, very sad. But I have his work, and I've really pored over it and done a very detailed study of it, and I'm going to show you exactly what I found. So this is data right through the present, from March 1602 right through the present. I also have it for the Dow, but we're going to focus on the S&P chart. Here are the dominant peaks that I've highlighted. Of course, the beginning of trading was in 1602. There was a peak in Amsterdam in 1649. There was another peak, and I didn't pencil it in here, but 1720 in Great Britain. That was the South Sea bubble. There was another peak here in the United States in 1835, 1929. And before we get too much further, let's see if we can just make some sense of what's going on here. From 1602 to the peak in 1649 was 47 years. Isn't that interesting? 47 years is a Lucas number. From 1649 to 1835 was 186 years, which happens to be Lucas 47 times 4. From 1835 to 1929, 94 years. Again, Lucas 47 times 2. Do we have a pattern here? Well, my mouse seems to give me a fit here. For some reason, I can't go to the next chart, and I don't know why. Well, shucks. Well, for the life of me, I don't know what's happened here. Okay. Well, we're going to have to maybe shut it down and start it again, I guess. Oh, here we go. Working once again. I apologize for that. Loose electron somewhere, I guess. Okay, here's the same chart as the last one, but I put a lot more data on here. And you're welcome to take a screenshot. Of course, this is being recorded as well, so the viewers can go back and scrutinize this in greater detail later on. But over on the left, we've got 1602, when the Dutch East India Company was founded. 47 years, 1649. 72 years, which happens to be Lucas 18 times 4, marked the South Sea bubble peak in 1720. Incidentally, a little side note, my great-great-grandfather to the 10th, his name was Robert Harley, Lord Robert Harley, was commissioned to come up with a way to deal with the war debt that Britain and the Netherlands had amassed in their war against Spain and France. And he conceived of an idea of developing some commercial paper that would buy the war debt from the British government and then sell it to public investors. And this company, the South Sea Company, was also engaged in trade to South America and to North America. And it went on like gangbusters. It was the Microsoft of the day. And my great-great-grandfather was a hero until it peaked in August of 1720 at the peak of the frenzy, and then collapsed. And of course, Britain went into a serious recession. We made a bottom there in 1722 and another one in 1784. Unfortunately, my great-grandfather got sacked. But anyway, that's a side story of that one. Here in the United States, 116 years later, which happens to be Lucas 29 times 4, we had a peak in 1835. 94 years, Lucas 47 times 2, 1929. What's going on here? Well, the primary function across the peaks can be defined by the Lucas number 47. That's quite evident. What it's telling me is 47 times 2 and 47 times 4. Of course, I've defined all the peaks. We have what appears to be a 94-year cycle as the operable function. It's highly suggestive to me that when you take 1602, you had 47, 188, 94, 94, which equates to the year 2025. This is the year 2024. Oh my gosh. Let's pay very, very close attention to what's going on. We could be very, very close to a major secular peak. Across the bottom, again, you have the similar Lucas functions defining all of the troughs. I've shown them there, 105, 58, 58, 94. And if the pattern continues, it suggests a major low coming in the year 2029. Let's step it down. Let's just look at the last 100 years. This is a chart of the Dow Industrials going back 100 years. And this is a log chart. So what I've done here is I've counted forward in time from the 1929 peak, and note 36 years into the 1966 peak, 58 years into the 1987 peak, 72 years into the 2000 peak. There are others, but I just chose these three. And these numbers that you see on the screen are all derivatives of Lucas numbers. 36, of course, is Lucas 18 times 2. 58, Lucas 29 times 2. And 72 is Lucas 18 times 4. What is it suggesting? Well, the sequential counts and the Fibonacci ratios are suggesting that we are perhaps right in the heart of the envelope for what could be a 94-year cycle peak. Let's take the exact same chart, but instead of years, let's put some numbers on here. Let's use monthly time counts. Look at the time period between the 1929 peak and the 1942 bottom. It was 151 years. That is 152, which happens to be Lucas 76 times 2. Fast forward 520 months. Took us to the January 1973 peak. Clearly, the operable function there is Lucas 521. And if you forget the Lucas numbers, I've got the table over there in the upper left-hand corner. Count forward another approximately 322 Lucas months, and you get to the peak in 2000. And then so on and so forth. 94, 94, 76. And I'm thinking maybe Lucas 18 times 2, 36 months from the 2022 high might take us to another peak. And that would be end of this year, first of next. All right, let's scrunch the time span down a little bit shorter. Let's look at the last 60 years. And let's take a look at what's happening across the pattern of lows. A number of analysts over the last couple of days have made reference to the so-called 4-year cycle. Here it is from 1962 through the year 2002. The dominant cycle was what many folks refer to as the 4-year cycle. Actually, it was 49.2 months to be exact. And I showed you this number several slides ago. Its root derivation is based on the Fibonacci 55 multiplied by 2 divided by square root 5. That is 49.2. And that is the mathematical derivation for that 4-year cycle. I heard Bill Sarubbi a little while ago musing about other folks who have trying to define it, trying to tie it to the Federal Reserve or maybe the presidential election, and then he pointed out that this thing was operable even before there was a Federal Reserve. Well, yes. Ergo, it has nothing to do with those things. It's mathematically based. Let's carry it into the present time. Something very interesting happened at the 2002 bottom. Oof, the 4-year cycle vanished. It went away. Well, no, it really didn't go away. It just expanded by Fibonacci 1.618. So it expanded to 79.6 months, which happens to be the next Fibonacci number in the series, number 89, multiplied by 2, divided by square root 5, which equates to 79.6. And that is the mathematical derivation for that cycle. And as you can see across the pattern of lows from 2002 through the most recent low we had in October of 2022, that cycle was the operable function. Now, here's what's interesting. Between February of 2016 and October of 2022, we had which looks like to me like 2 subcycles, which I call Alpha and Bravo, which happen to be 49.2 and 30.4, which, as you can see on the screen. It remains to be seen whether spinning out from the October 2022 bottom will pick up the 49-month sequence, or it will pick up the 79.6-month sequence. I favor the latter based on my analysis of that and some other highs and lows and looking for clusterings. I actually think the 79.6 cycle is going to continue. What does that tell me? It means to look for the next low, significant low in the vicinity of May, June of 2029. Of course, before we get to a low, we have to have a high. And I think that's coming within a year's time. One more thing, take note of what's called translation. And I'll get into I'll get into this again, but this is probably a good time to illustrate it. Take note of the 79.6 cycle. Well, even the cycle, the chart previous this, all the 49-month and 79.6-month cycles were characterized by right translation. What does that mean? It means the crest or the high point in price occurred to the right of the midpoint. And when that happens, that's characteristic of bull market structure, a rising environment. We had that all the way through the October 22 bottom. Now, if we get a high in about a year's time, which I think likely, we will, for the first time, have left translation in that cyclical series. Left translation is characteristic of bear market structure. Yet to be seen, but that's something that we should be watching for. We started out with looking at yearly counts, and then monthly. Let's take it down to weekly analysis. This is the S&P 500 weekly chart from 1982 all the way through this morning when I printed it off. And let's spend a moment analyzing this. I found, again, our friends, the Lucas counts, have defined every single high, 100%, counting from the crash low day on October the 20th, 1987. The high that occurred, remember this is the S&P, not the Dow, the high that occurred on March 24th, 2000 was 648 weeks from that crash low, which happens to be 4 weeks from 644, which is Lucas. Look, you can look at the little table to the left. Lucas 322 times 2 is 644. The next high on October 11th, 2007 occurred 394 weeks later. 394 is within 4 units of 398, which is Lucas 199 times 2. The next significant high, May 20th, 2015, 397 weeks. Again, 398, Lucas 199 times 2. The high we saw, Feb 2020, 248 weeks from the prior high. That's Lucas 123 times 2, 246. The most recent high we had in January 2022 was within 4 weeks of being exactly 94, i.e. Lucas 47 times 2 weeks from the prior high. What's the message here? The message here is every single high, every one, can be defined by the Lucas series multiplied by 2. Now, if we count forward in time from January 4th, 2022, the first number to pick up would be 94. 94, of course, is Lucas 47 times 2. Well, that fell in October of last year, so that's not going to work. So what's the next number? The next number in the series is Lucas 76 times 2 is 152. So if Stan's theory is correct, we should be looking for a significant high in the vicinity of 152 weeks, which is, again, a Lucas number multiplied by 2. That equates to the first week in November of this year. The first week in November of this year. Do we have an election going on about that time? Interesting. Let's take it down a notch, further notch. Here is the S&P 500 going back to July 2018, all the way through this morning at 11:28 a.m. Eastern Time. This is the dominant cycle on the weekly charts. I call it the primary cycle, the primary weekly cycle. I wrote an article on this in the Cycles magazine about 3 years ago. What I did was I went back many, many years and analyzed the dominant troughs on the weekly charts and they expand and they contract. But nominally, the sequence spans right at 34 weeks or 8 months. Sometimes it's a little more, sometimes it's less. But when I put the data into a regression spread, put it into a spreadsheet, do a regression analysis, plot it on a histogram, the nominal peak is right at 34 weeks or 8 months. As you can see, sometimes it has expanded a little bit to 49. Sometimes it contracted to 20, 21. You all probably recognize those numbers as Fibonacci numbers. Assuming the pattern continues, and I believe it will, we should be looking for the next low in this series in the vicinity of right around the first week in July. Let's take it down a notch further and let's look at the daily data. Over the last couple of years, certainly since early part of 2021, the dominant troughs on the charts have been occurring either side of about 53 trading days. 53, 56, 79, 81, 49, 53. Yes, cycles are not always a precise clock. They do this. I wish it were that easy. But yes, they do expand and contract. And if you take the number 79.6, multiply by 2 over 3, 79.6 is about 80, round it off, times 2 over 3, you get 53. So the 80-day cycle, the 53-day cycle, they are related by the factor of 3 to 2, 2 to 3. Dominant highs have been occurring at approximately 80 trading days as well. But my focus for this chart is primarily the 53-day cycle. It expanded a couple of times by 1.5. Did it twice, and then it returned right back to its regular heartbeat. And assuming the pattern continues, and what I've done here is I put all those dates into the spreadsheet, and it says, look in the vicinity of January 19th for the next sequential low in that series. And here's an important point. That's one part of the thing that you and I need to know. The other thing we need to know is, what is the standard deviation? And by analyzing the pattern of lows, the computational methodology can tell us that. The standard deviation is right here. It's 3.061 trading days. What does that tell us? It tells us to look towards the potential, not the certainty, but the potential for the next 53-day cycle to occur in the vicinity of January 19th. There is a 68% probability of that occurring within one standard deviation. There is a 95% probability of that occurring within 2 standard deviations. And that's the best we can do mathematically. We can't do any better than that. That day, by the way, I believe is when the current continuing resolution that we here in the USA are operating on. And Congress, in order to avoid a government shutdown, by that date has got to come up with a fix. Here is another cycle that has defined pivot points. It's not a low to low cycle. It's what I call a trend change cycle. So there are different types of cycles. There are low to low cycles. There are variable cycles. And then there are fixed cycles, but they don't necessarily denote troughs or crests. They merely denote changes in trend. And here is a good example of that third type of cycle. It spans about 120 trading days, and it's due in the vicinity of January 22nd with a standard deviation of 3.2 trading days. So again, that tells us right around that time window, with a 68% probability of 3 trading days, we should be looking for a turn in the vicinity of that date. And here is the mathematical analysis in a spreadsheet. And then this is what I was just talking about a moment ago. There are 3 types of market cycles. There are fixed beat cycles, meaning troughs occur at fairly regular heartbeats. For example, that 49.2 month cycle that was prevalent between 1962 and 2002. There are variable cycles like that 34-week or 53 trading day cycle. They expand and contract. But the nominal heartbeat for those cycles in these two cases is 34 weeks and 53 days. But they can vary. They expand and they contract. Sometimes they skip a beat, only later to recur. And then there are trend change cycles. That's the third type, meaning they don't necessarily denote troughs all the time or crests all the time. They merely indicate the potential for a trend change. I know newbies to cycles get frustrated. They want that fixed beat oscillator that tells them, oh, by golly, every 53 days, plus or minus zero, we're going to have a low. And then when that doesn't happen, they get frustrated and they criticize those of us who are cycles practitioners for having a tool that they consider worthless, and they toss it in the trash can. But if they only understood the nuances of cycles, and I think most people in this group do understand that, we have a marvelous, and I mean a marvelous tool at our disposal to assist us with defining how markets move and to forecast turning points in the future. But it is an imperative that we not only understand the mathematical crux behind these cycles, but we understand their nuances, their expansion, their contractions. Sometimes they skip a beat, only later to recur. Having all that in the brain cells, we've got a very, very powerful tool here. Another concept of cycles that I addressed a few minutes ago is the notion of translation. And actually, this was first brought to my attention by the late Walter Brezert. He talked about it in his book, The Power of Oscillator Cycle Combinations. This chart illustrates it very, very well. Across the top, you can see an idealized sinusoidal cycle. Over on the left side, you can see where the crest of the cycle actually leans to the right of the midpoint. That's known as right translation, and it's characteristic of bull market structure. Now, when a market peaks and starts heading southbound, the crests or the high point in price tend to occur to the left of the midpoint. That's known as left translation, and that's characteristic of a bear market environment. Here is a daily chart of the S&P, current as of 12:39 p.m. Eastern Time today, when I printed this off. And I just wanted to share with you some of the Lucas functions that work not only on the yearly chart, not only on the monthly, not only on the weekly, but they work on the daily as well. Take a look at this. Here's the low on the lower left-hand corner that occurred back on October the 13th of 2022. You count forward in time exactly 47 Lucas days. It takes you to the first low that occurred in December of that year. If you count forward in time a precise Lucas 76 days, by golly, it lines up to the day, February 2nd, 2023. We had a high there. If we count forward in time 152 trading days, which is Lucas 76 times 2, that lined up with the high that occurred in May of 2023 within 2 trading days. The next number in the sequence is 199. Lucas 199, when added to the October low of last year, lines up with August the 1st, 2023. The Dow topped on August 1st. The S&P topped 3 trading days prior. The next number in the sequence is 322. That lines up with right in the vicinity of January 19 to January 22, which is when I have those other cycles clustering as well. Oh, by the way, when you add 47 trading days to the low that we saw on October 27th, lined up to the day of the low we saw here just a few days ago. So what I think is likely to occur, I mean, I am big picture bullish into the end of the year. November looks very, very interesting. December, early part of next year. That swath of time is really, really high on my list for what could be a 94-year secular peak. But between now and then, I think the path of least resistance is northbound. In the near term, we probably have a little chop shop going on. I'm going to be watching what goes on right around the 19th to 22nd of January. But I think any pullback is a gift for the long side investor, because I think this market is heading higher. The Dow is already at a new high. The S&P and NASDAQ, New York Comp and transports are not. My guess is before you know it, you're going to see the S&P and the NAS take out their former highs. I'd be surprised if the transports go to a new high. So it's entirely plausible, and it's a little early to say. But at the final peak, when it does occur, we're going to see some divergences popping up. And it might be the transports don't go to a new high, and that might be one of the largest divergences we see on the charts. And we got a lot of time to focus on that. But in the near time, my takeaway is I believe the dominant trend is northbound into the end of the year. And if everything still looks like what I've shown you so far, getting to the election time, I'm going to be really, really looking closely for evidence of signs of a major peak. Let's look at interest rates. Richard Mogi, in the package he sent me, contained interest rate data all the way back to 1753 through the present. Oh. And I've had to annotate it from when he gave it to me in early 2020. Our good friend, Mr. Lucas, he's at it again. Take a look at the pattern of highs and the pattern of lows. Look across the peaks. Lucas 47, Lucas 76, Lucas 58, which is Lucas 29 times 2. Those are the operable functions defining the major peaks in interest rates. Look at the troughs. 32 months, that's Lucas 29. Lucas 76, right to the month. 46 months across the bottom there, Lucas 47 with 1 month, and so on. Takeaway here, you and I need to understand Lucas numbers and their relationships cold, ice cold. Here is the 30-year mortgage, and oh my gosh, in the last couple of years, this has just skyrocketed. I don't think we're going to see those lows from a couple of years ago again in our lifetime. There is another cycle, which I didn't make a chart of, in more recent years, 40 years. It's the number 39.8, which is 89 divided by square root 5, rounded off to 40. If you take the low that occurred in 2020, 2021, subtract 40 years, that takes you to the 1981 top in October of that year, when interest rates were up around 17%. I remember it vividly. As a young naval officer, I bought my first home at that time. Ouch. 40 years prior to that, summer of 1940, interest rates made a low. 40 years prior to that, in 1900, they made a low. 40 years prior to that, in 1860, they made a high, and so on. So there's a 39.8-year cycle, and I'm sorry, I forgot to make a chart of that. All right, let's talk about the precious yellow stuff. Here's gold. Here's a chart of gold trading back to 1970. Take a look at the troughs, and I have written down the time counts from low to low, March of 76, Feb 85, March of 93, and so on. And those numbers are in months: 102, 97, 97, 90, 86. Does anybody see anything that looks vaguely familiar? Well, what about the number 94? Again, remember 94 defines the tops in the stock market in years? Well, here we have a different market. Lucas 47 times 2, 94, plus or minus 8 months, has defined every single low on the gold chart. Every single one. Every single one. And I put those data points into a spreadsheet, and the regression analysis points to May of this year for the next low in that cycle. Standard deviation of 6 months, which is relatively wide, about 6%. But hey, that's what the data gives us. We can't do any better than that. So the takeaway here is that the gold complex is likely, not definitively, but we should be looking to the May-ish timeframe, plus or minus. And there's some other techniques that I employ to narrow it down, but just based on this cycle. My message is we should be looking towards the May plus or minus timeframe for the next low in gold. And then from that point, I think we will push higher. Bitcoin in the news today. ETF approved. Everybody loves it, right? Let's take a look at Bitcoin. This is right through today, from the very first day of trading through today. What I've done here is I've put it in log format, so it's easily readable. The numbers down the left side, it says 000. It's not 00, it's just very, very small. I didn't show all the decimal points. But the takeaway here is you can see that Bitcoin on a log chart tends to make spike peaks and rounded bottoms. Now, can we make any sense of the pattern in Bitcoin? Probably most people will look at that and they'll say, impossible, impossible. Well, let's see if maybe we can refute that thinking. Okay, here's exactly the same chart, and I put some dates, and I've put some vertical lines on here, and the time counts are in months. And take note of this high that occurred on July 11th, the first major spike peak on June the 8th, 2011. That occurred 11 months from the very first day of trading. Remember Lucas numbers? 11 is a Lucas number. Interesting. Okay. The next high occurred on April the 10th, 2013, 22 months later. Whoa, Lucas 11 times 2 is 22. Oh my gosh. Interesting. Okay, next high, November 29, 2013. That occurred 29 months after June 2011. Oh my gosh, 29, Lucas number. Fast forward in time, December 2017. That peak occurred 78 months from June 2011, which happens to be within 2 months of Lucas 76. The next one occurred 96 months later, which is within 2 months of Lucas 94. The peak in November of 2021 occurred within 2 months of Lucas number 123. What's the takeaway? Clearly, the Lucas numbers and their times 2 multiples have defined every single market peak in Bitcoin, 100%, all of them, every one. Okay, what's the next number in the series? Well, the next number in the series is 152, which is Lucas 76 times 2. When does that occur? You can see where I drew the vertical line. All right, let's look at the daily chart of Bitcoin over the last 3 or 4 years, all the way through the present. And what I found is all of the pivots from the all-time high that occurred in November of 2021 line up, oh my gosh, with the major Fibonacci relationships of ratios of 0.146, 236, 382, 618. Isn't that interesting? So I put those into a spreadsheet and I model it mathematically utilizing what's called regression analysis. Here's the X column, which is the Fibonacci ratios. The numbers under the Y column are the calendar days in my spreadsheet, or those are the calendar days from the very first day of trading. This is the actual date under turning point. And then from the regression analysis, I construct a linear equation of the form y equals mx plus b. And then I'm able to project in time by projecting this equation out into the future. If the pattern continues, if the function continues, then when should we be looking for the next pivotal turn? And the analysis would suggest July 12th of this year with a standard deviation of just under 6 trading days. So that suggests July 12th, 68% probability of a high occurring within 6 trading days. 2 standard deviations would be double that. And given that proximity to what I showed on the prior chart, this one right here, I'm inclined to believe it's going to be a significant high in Bitcoin. Will it be the final high? I don't know, but I think it will be a significant high. Let's just recap what we talked about today. My discipline is market kinematics. I want to understand how markets move mathematically. I don't care the fundamentals. I don't care what pushes them. I don't care about what the Federal Reserve or anything else happens to occur. I just want to look at the charts. I want to try to model things mathematically. And if I can do that, I can make some reasonable inferences about what is likely to occur in the future. How do I do that? I look at all things Fibonacci, all things Lucas. I look at cycles, and there are 3 types of cycles, as you know. There are fixed, there are variable, and there are change in trend cycles. And I look at translation, left and right. We've looked at the stock market from a long-term down to the short-term perspective. We've looked at interest rates. We've looked at precious metals. And lastly, we looked at Bitcoin. I think you have to work very hard to make easy money. And don't forget this. W.D. Gann said, "The man who refuses to change his mind will soon have no change to mind." Do I change my mind? Oh, you bet, in a heartbeat. Yeah. If down the road something changes in my mind, either new data comes in, or maybe I look at old data with a fresh set of eyes, will I change my mind? You bet.
That was incredible, Stan.
Thank you.
Thank you. What a fantastic presentation. And boy, that data from Richard Mogi was incredible. Thanks for sharing that with us.
Thank you.
Ron, didn't mean to jump in on you, but
I have to put us back in terms of our FSC group chat. I think
okay.
a number of our board members are online.
Good. All right. So thank you again, Stan. We're just going to wrap up the event here with a little gathering of the board members from around the world, and many of whom it's the wee hours of the morning. So thank you very much for joining, for sticking with us, especially all you Europeans. So we, I guess, do we also have Jake?
Right here.
And Bill Sarubbi? Can you join us?
I am here.
Okay. Very good. I was, let's see, Bill Sarubbi, are you gonna, there you are. You're there too. All right.
Stan, fabulous presentation, Stan.
Thank you, Jake. Thank you.
Love it.
What an incredible event we've had. The speakers have just been extraordinary. Everybody, this event was very important to me, not just as my role in the foundation, but personally for how I'm, thinking about the year ahead, what I'm doing with my own investments, my own decisions. I really saw an incredible amount of consistency across the speakers, and I just want to briefly show some of the highlights that that we saw over the past few days. So give me just a second here. And see if this works from current. swap. All right, so we had Akhil Patel and Andy give us a nice presentation before the event. This is available on YouTube, where we looked at Akhil's and Phil Anderson's 18.6-year real estate cycle, right? Here we are, and peaking around 2025, 26. We saw this theme over and over again. Larry Williams joined us. This was his forecast that he gave at the foundation last year, and how it actually panned out. Pretty extraordinary forecast there, all done in December 22, and that's, you know, the real data from 23. And this teal line here, or blue line, is his decennial forecast for 2024 using the best fit years. And, you know, we saw, well, he's got this kind of rise into March. We'll see. Some of our other analysts thought we'd see some declines, but, you know, kind of bottoming in July, August here. And we saw that a lot. I thought it was interesting how he forecasted inflation using cycles. I think that was a great idea. And then his decennial forecast, you know, showing a top around 2026, similar to, again, the real estate cycle, and this being quite worrisome. Lars, of course, gave us our Bitcoin forecast, also peaking, you know, somewhere in 2025, 26.
Yeah, and just to
Yep.
comment on that, because then the 3, which is shown here, so this is exactly, I think, end of June. So you had beginning of July. So the 200-day cycle here is similar to your next count of the Lucas series. So that's quite interesting.
I thought the same thing as you were giving that presentation.
Yeah, yeah.
I noted that.
Yeah, great. Jake gave us some fantastic insights, covered some other markets, and just this pattern of, you know, a cycle low with strong commercial buying and weak small trader sentiment. Showing up again and again. Soybean oil was one of the compelling ones. Copper, expecting a bottom sometime in 2024. Thanks for these fantastic charts, Jake. Treasury bonds, this is interesting. You know, some bullishness in bonds, which would mean lower rates, you know. And look, I think we all agree that we've seen the 40-year bottom in bonds and treasuries, but these, you know, the next 40 years of rising rates is decades, right? So we could see a year or two of interest rates coming down. But the S&P, also Jake bullish, similar to a lot of the other analysts, Larry, Bill, bullish here into 2025, 26, with strong support from the commercials also. And of course, your palladium forecast, Jake, looking forward to that opportunity. All right, Bob Prechter, obviously bearish, but you know, some of the charts that I just pulled 2 here that Bob showed, because I personally find these things really disconcerting, and I think it's not inconsistent with the idea that we might see a top 2025, 26, but these are just crazy, you know, outlier valuations going on. 2019, 2020, 2021, 2022, 2023. This is, you know, low dividend yields over here on the right side and high price to book values on the vertical side. So we're clearly in a kind of no man's land in terms of valuations. And I think it gives, I think we should all be thinking about, you know, maybe it's not going to be a crash this year, but I think we have to be prepared for a significant correction in the next few years. And I think that starts today. And this chart also just is crazy to me, that stocks have risen 200 times commodities in the past 100 years, right? We are seeing some correction in this, but still these kinds of imbalances just are hard to fathom. All right, Bill, your main forecast, your 1-4-10 forecast, bottoming into July here, rising into the end of the year, consistent with a lot of the other forecasts, zeroing in on kind of the first quarter here. And then Stan, thank you for all this incredible information. Too much detail to go over in detail, but you know, not dissimilar forecast from let me get to, you know, November 1, 2024. I love that correspondence with the election. So I just you know, share that with everybody because I thought it was pretty extraordinary how consistent the speakers have been with one another. There we are, stop share. Any comments on that?
It was a lot of fun. Let's do it again next year.
Andy, I know you didn't really have a chance to present your work. You interviewed Akil. Thank you for that. But I know that maybe you want to take a few minutes and just share what you're seeing for the coming year, if you don't mind.
Sure. So yeah, I was supposed to be in the depths of West Africa there, so I couldn't guarantee a decent internet connection. So first of all, Stan, what an incredible presentation. So one thing that's come across, if I might just say, from all the many speakers, incredible presentations, Jake, Larry, Bob, Bill, Lars, all of you, a lot of information coming in. Now, Stan is a former Top Gun. And I have a very big background in aviation, which I don't openly talk about, but I'm now going to start explaining this. What pilots do, so, and the background to this is 95% of traders go out of business very quickly at a retail level, and 95% of portfolio managers fail to give consistent returns over 5 years. Why? Yeah, if we go to an aviation industry, I'm sure Stan will tell us, he probably knows a lot of pilots have got the same number of landings as takeoffs. And it's certainly the same. I mean, there are 1 or 2, aren't they, Stan, right? So what is it that creates this 100% consistency in one industry? And what can we learn from that? And it's a thing, one of the things is called situational awareness, all right? So the idea is bringing in all this information, which is exactly what we've done over the last 3 days from all the various speakers, synthesizing that and sitting down and working out the signal from what could be otherwise perceived as the noise. And the more you understand about what lies around you, now let's face it, and Stan said this very clearly in his presentation, the cycles give us a distinct advantage. So the ability to synthesize that information, sit it down and put it into a trading plan is where you will get a tremendous edge. And this is one of the things we can learn. The more situational awareness you have, the better you are, you're going to succeed. That's the first point I wanted to make. My view is that we have, using my cycle work, which I haven't had a chance to present, there are a couple of points that are coming out, which tie in with Bill and Stan. I'm seeing a significant turning point on the S&P 500 around about the 21st to 22nd of January on a daily basis, and a more significant turning point around about the 6th of March. Jake showed us bean oil, got a very significant turning point on bean oil coming up over the next 10 days. So the commitment of traders data is giving us information that ties in with mathematical cycles. The other thing is, one of the things that the commitment of traders data is showing is that the Dow Jones futures have actually shown an incredible sell-off of commercial buying. And that needs to put us on aware for a potential pullback. So again, I'm in agreement with most of the presenters that we might well see a pullback, not necessarily a crash, but I'm also more bullish towards the end of the year. Finally, just to take a couple of sentences, I want to just give, I'm just working on my market timing report year ahead forecast, which covers a lot of geopolitical ideas. And the purpose behind this is so you can then look at your trading strategies. Those of you who followed the work, which was on the YouTube channels for both the FSC and also myself, we put historic geopolitical cycles up there. We're in a 250-year cycle from the American Revolution. Okay. Now we've seen that 250-year cycles can see the rise and fall of empires. Within that, we get harmonics of a third of roughly 82 to 83 years, and each of these lead to revolutions. So we're in a critical time point, and we've been in this for a few years. Now, what's really important about 2024 is that we have over 50 nations having significant elections coming up, and they've already started. And 43 of those are really important countries, bringing in 4.2 billion people capable of voting. So this could be a very interesting turning point for democracy as we know it, given the challenges we've faced in the credibility of elections. The 250-year cycle, really, when America got its independence from Britain, that pursued other nations. France started the French Revolution, really 1789, spurred by the American belief system. So I think we're at the beginning of a massive change in outlook. And the other thing we're seeing is that the younger voters now are so concerned about threats like migration that they're actually becoming more authoritarian. So we are going to see a swing towards the right. And with that, we bring in the 90-year cycle, which saw some extremes of behavioral and patterns and belief systems. So, Richard, I don't want to take any more time. I could talk to you forever about that, but that's just a few inputs as I wasn't able to present. And I'm actually glad to be here at home rather than over in Nigeria today.
Thank you, Andy. And Bob Prechter talked about some of those too in the 233-year Fibonacci number from the Constitutional Convention, right? And also kind of this tension between the kind of republic ideals versus the more kind of democracy, majority, authoritarian situation that we seem to be at risk of. So yeah, that all lines up great. Anybody have any advice for our readers who have taken our viewers, who are taking all this in? I'm pretty happy that overall, I think the message was pretty consistent. But how should, let's see, how can we help people the most to like take this information like you're talking about, Andy, situational awareness? How do people make this their own and, really use it?
If I may say something.
Yeah, please, Jake.
I think our job is done. It's up to the individual to take the information and use the information within the context of their own analysis of risk and reward. So there's no one size fits all. The information speaks for itself.
I agree. I guess thank you for bringing up that point, Jake, and just want to reiterate, everybody does have to make this their own, everybody on this screen will tell you it doesn't matter how good your forecasts are, you've still got to manage your risk, manage your positions, make sure you don't get out over your skis. So, Jake talked about that a lot in his work with setup, timing, and setup, trigger, and follow through. So let's just kind of put an exclamation point on that here at the end of.
Can I come in on that, Richard, just briefly?
Please. Yeah.
So again, in the vein of strict professional standards within other industries, and again, going to flying, I think Jake gave us the best example of taking everything in a nice, orderly way. So think about what your trading horizons are, whether you're an investor or a trader. Think about the situational awareness you're gaining, and then think about how you're going to filter the signal from the noise and put that into a checklist. It's the checklists that solidify everything. And with that checklist, use the trading systems that you've learned from whoever you've learned from and manage that risk accordingly, because it's all well and good having all these great ideas. The market's going to do, the market's going to do that. And, we're all sitting here, and remember, we're all human beings, and therefore we're subject to hope, fear, and greed. And we can go away from here thinking, wow, we know exactly what the market's going to do. Or do we? How do we capture that? So capture these points, put them into a checklist, and I think all the techniques here and the information, and I think that will really serve everybody.
Larry Williams gave a great example in his talk where it was like, we had that kind of bottom-ish event in October, but then we had a new bottom in November, right? And he had been going long, and he was under pressure there when you got those new lows, and that happens, he ended up making a lot of money, but he ended up being quite uncomfortable there in that kind of new lows in November after the October lows. So
One
that's the
one
kind of
thing I
situation. Yeah,
one
Jake.
thing I'd like to add into the mix. Wonderful comment there, Andy. Let's not forget the wild card in this whole process is artificial intelligence. We have no idea where that's going to take us. We have no idea where it's going to lead us in terms of fake news, fake prices, fake markets, and so forth. And that is something we have to be on the lookout for.
Well, actually, we covered this in the YouTube video we did as a preamble to the opening of this. When Akil and I were speaking, one of the things about AI is that those of you who've studied, and Gan talks about this a lot, that the booms that come in are fueled by the prevalent technology. So, for example, we've seen booms based on railroads in the 1800s. Then we saw technology, cars, followed by aircraft. Cars, television, radio, television, RCA being in 1929, and then aircraft. So then we saw the dot-com boom. And so what are we seeing next? It's going to be AI. AI is going to drive some of the booms and busts, those companies that do that. But I think this would be a great topic to debate at some point. I don't think AI could ever crack a market, because the market is really the sum total of human hope, fear, and greed. And that's just a personal view, because that's going to change as AI comes in. And if AI is able to absolutely finesse a market, there is no market because there is no exchange.
My concern is not that AI will be able to finesse a market. My concern is with fake news and fake numbers. I think that's the real issue here. And I'll be speaking to that next week at the Wealth Conference.
Very good. Thank you, guys. Any other closing thoughts? All right. Well, my closing thought is make sure you become a member of the Foundation for the Study of Cycles if you're not already, and stick with us through the year. Very proud of the work we did last year. The forecasts were made last year at the annual event were fantastic. I was skeptical, but it turned out to really be a year of cycles, and I think 2024 is going to be the same. So thank you so much, everybody. Thank you all our presenters. Incredible information. We've made this available for free on YouTube, so we appreciate everybody's support. Very proud to be able to bring you this work. And finally, keep an eye out for Dewey's book. Let me just share my screen one more time.
With a cover like that, you can't miss it.
Check it out, Jake. Hold on a sec. Here we go. So this is the final cover, the front and the back cover. Jake, you made the back cover. I turned all the testimonials over to Harriman House, and they picked the ones for the back cover. All the other testimonials are on the inside. And the book is coming out great, and it's going to be available in March. It's actually already up on Amazon. So everybody, thanks for all your support. It's going to be a great year for the foundation. And if you haven't become a member yet, please do. So thank you again, everybody. And I wish everybody a good night and a good 2024.
And let us hope we're here again next year to do this.
Amen. I'm sure we will be.
One
All right.
way.
Thanks, everybody. Good night.
Thank you.
Good night.